Hi, I'm Steve Richardson, and this is the February 2019 episode of Lunch with a Lawyer. We're going to talk today about credit scores and credit reports because there's a lot of misinformation out there and people don't fully understand what the scores are, what they mean, what constitutes good credit, what constitutes bad credit, what you have to do to build good credit, that sort of thing. So we're going to dig in deep on this episode to talk about just that. And really, the first question is, in talking about credit scores, is what is a credit score? Well, in the old days, going back to pre-1950s, if you wanted credit, you wanted to take out a loan, you'd go to your local banker, to the loan officer, sit down, and they'd interview you, go over your credit references and financial information and things like that. And the issuance of credit was really sort of a gut call by the loan officer or maybe his or her superiors at the bank and whatever their lending guidelines are. And it could be a long and arduous process. Certainly anybody applying for a mortgage knows that even these days. But it took a while. And it was anything but objective. It was a very subjective judgment call. But in the 1950s, in 1958, a couple of gentlemen by the name of Bill Fair and Earl Isaac got together, and they wanted to come up with a modeling system for judging creditworthiness, and come up with a mathematical formula to generate a numerical score for your credit. And that would allow for much faster turnaround in the issuance and decisions on issuance of credit, and make it a lot more objective and a lot more standardized. And that would, you see more these days in the past 10, 20 years, companies advertising, you can know within 24 hours whether you qualify. Well, that's because of these scores. And Bill Fair and Earl Isaac created the Fair-Isaac Company, or FICO, F-I-C-O, and that's why you hear about FICO scores. It looked at what made someone a credit risk and what indicated responsible handling of credit. And it's a score of 300 to 850. I call it the SAT score of life because basically that's what it is. It's very similar in scoring and the numbers, and it's something that really determines a lot of things for you. So what does that number mean? Well, if you have an 800 or higher, you have exceptional credit. No problem. You're in the zone. You're where you want to be, and there's really nothing better than that. Anywhere from 750 to 799 is considered excellent credit. 700 to 749 is good. 640 to 699 is considered fair. 580 to 639 is poor. And if you're below 580, you have bad credit. That's pretty much the definition of bad credit. So that's, if you know what your scores are, that's a way of determining where you fall on that continuum, what that score means in terms of how you're going to be looked at in terms of credit, credit risk, credit worthiness, and credit responsibility. Now, you want a high score because the higher your score, first of all, the more likely you are to be approved for credit. Secondly, you'll get even if you are approved for credit, you will most likely get a lower interest rate than you would ordinarily for things like car loans and things like that. You see advertisings where they talk about interest rates for qualified buyers. Well, that's what they're talking about. They look at your score. And also, there are a lot of rewards cards. You see, Capital One, what's in your wallet, all these different perks and things that you get with a credit card. And the nicer cards, the nicer perks come with a higher credit score. So this is something you really want to build up and maintain. Now, there are three different scores under FICO. And what I'm going to be talking about mainly today are FICO scores. There are many other different types of scores. There's the Vantage score and other things I'll get into in a minute, but really we're talking about right now the FICO score. And the three scores are each based on the content of a credit report. So your Equifax, Experian, and TransUnion credit reports each have its own score. And not every credit lender reports to all three. So depending upon how long you've had a credit history, how long your history is, will depend on how robust each report is and how accurate each score is. If you're just starting out and you got a credit card and maybe one other piece of credit like a car loan, and that's reported on one or two of your credit reports, and you apply for credit and that credit lender pulls that third report to review or that third score, then none of your other credit history is going to show and you may run into a problem there. So just be aware there are three scores, one for each of the three reports. And you can get a free copy of your credit reports once every 12 months from annualcreditreport.com. What I recommend you do is get one report every 4 months. So start off with Experian, in 4 months get Equifax, and another 4 months get TransUnion, and then 4 months after that get the first one again. So on a rotational basis, every 4 months you're looking at your report and you're more likely to find out if there's a problem on any one of them. So those are the scores and where they come from. Now these credit scores these days are used for a lot of things, not just for getting credit. Again, it's your SAT score of life. If you apply for a job where you might be handling money, they're going to want to see your something about your credit report or see your credit score. If you are trying to get a security clearance, that can be important. What you pay in an insurance premium, believe it or not, can go up or down based on what your credit score is. Doesn't seem right. Doesn't seem right to me, but that's the way it is. So you need to be aware of that. Now, if you're thinking that your potential employer or something like that is going to see what you see when you look at your credit report, don't worry about that. They get a more limited version of it. It's called an Employment Insight Report, and it's more limited, less information than what a credit lender or you would see. And it never ever contains your credit score. So don't worry too much about that, but just be concerned because it all comes back to the reports, which I'll get into later. Now, what goes into that score of 300 to 850? Well, how the Fair Isaac company calculates it is held as secret as the Coca-Cola formula or McDonald's secret sauce. They don't go around talking about it. It's a proprietary formula. But we do know what goes into it and how each of those things are rated. Okay, so what the biggest thing that goes into it is your payment history. 35% of your score is based on your payment history. So as you can imagine, the worst thing you can do for your credit is to miss a payment on something, okay? Because that's 35%. Another 30% is what's called utilization. And I'll get into that in a little bit more detail in a minute, but essentially utilization is how you handle the credit that you're given. Do you go hog wild? Do you use it responsibly and pay it off? How do you use the credit that's given to you? Another 15% is the length of your credit history, how long you've had a history. And that's important. And I'll get into that in a minute. 10% for the types of credit used. Is there diversification of it? Is it all credit card debt? Is it, do you have some credit cards, a mortgage, a car loan, that sort of thing? How diverse is a type of credit? Because your responsibilities in each type of credit can be different. The good news is if you're starting out and trying to establish credit, if you have one credit card and you have student loans, all right, well, that's two different types of credit right there. So you have some diversity. So you get out of college, you got the student loans. Well, part of the silver lining is you get one credit card. Now you have some diversity in the types of credit. And the final thing is 10% is as to new credit. who's trusted you lately. These things come into play, but really the biggest two things that you need to concentrate on, which really makes up almost 2/3 of your score, is your payment history and your utilization. So we'll get into details on that in a minute, but the big question is, well, how do I get started? Okay. How do you get started on credit if you have no credit? Well, first of all, as I said, if you have student loans, you already have some credit. That's on your credit history, so that's good. You can get a secured credit card. Those cards have a security deposit that determines what your credit limit is, and as long as you make payments on time and do what you're supposed to do under the card agreement for at least 12 months, usually they'll convert it to a regular credit card. You want to make sure, though, that if you get a credit card, a secure credit card, that is with a reporting bank, so that first 12 months of payment history goes on your credit report, because you don't want to lose 12 months of payment history that you could have had. Okay, so make sure of that. And make sure you have some sort of credit on each of the 3 reports, which is why you want to make sure you're reviewing everything, reviewing a report every 4 months. Now, some key habits of credit card usage. Pay off the balance in full every month, okay? I can't say that enough. A credit card is a convenience. It should always just be a convenience for paying. So you don't have to write a check. You don't have to pull cash out of your wallet, although cash diets for some people are good. You can just use the credit card, pay it off every month, okay? That's key. And pay it off on time every month, okay? So that ties in payment history and utilization. You can set a reminder on your phone or your computer or whatever. Hey, when your calendar comes up, don't forget to make that credit card payment. I have one on my schedule, comes up every month. It's coming up for me. Hey, got to make that credit card payment so you don't forget. You can also pay online. Go online, make the payment. You don't have to worry about mailing a check. Does it get to them in time? Does it lost in the mail or anything else? You can make a payment directly from your bank account through the credit card issuer's website. That's what I do. And you make sure it's paid on time. And never use more than 30% of your credit limit. And I'll get into that as far as utilization is concerned, and that's where it's key. So let's say your credit limit on your card is $5,000. Then you should never use more than $1,500 of that $5,000. And if you pay it off every month, then that's good. It'll always stay below that. The problem when you carry a balance and don't pay it off every month is that utilization can creep up. All right. And once it creeps up above 30%, it can affect your score. Now, the 30% comes in a balancing act in the FICO equation because on the one hand, a credit lender gives you credit, they want you to use it. Okay, we gave you credit, use the credit. But every time you use credit, there's a risk that you won't pay it back. Okay, 30% is the tipping point. In other words, once you go above 30%, the risk of the debt outweighs the usage of the debt. So they become more concerned about your ability to pay once you go above 30%. Bear in mind that these scores don't take into account debt-to-income ratio. Excuse me. But that's where utilization becomes important. Now, if you have, it's not an aggregate, okay? So if you have 3 cards and you're looking at an aggregate of all 3 of the credit limits on those 3 cards, and let's say the credit limit on one card is 30% or less than your total credit limits, all right? Don't max out that card. Okay, it may be no more than 30% of your overall credit limits, but it's going to give you a utilization problem for that one creditor. So don't max out the card. Really, if you have more than one card, you really need one. I recommend only having one card. make sure that you don't go above 30% of your overall of the credit limit on each of the cards. Now, this won't happen immediately. It's going to take a few months for this to kick in, because what happens is the lenders, the credit card lender, may report to your credit reporting agency before they receive your payment. So the deadline, for example, for your payment to come in may be the 20th of the month, but they report the 15th of the month. So they'll report a balance on the 15th of the month, and they get your payment on the 20th. All right, but you have to get into a cycle of incurring debt and paying it for that overall balance reporting to kick in, so that it shows that you're not carrying a balance, that you're paying it off, and that you have good utilization. So also, if they increase your credit limit, I had somebody call and say, how do they're increasing my credit limit. I don't want them to do that. How do I make them stop? You don't want them to make them stop, okay? Because let's say your credit limit, for the sake of an easy number, is $5,000, and you've been really good with your utilization, your payment history, and say, we can trust you with even more credit. We're going to increase your credit limit to $10,000. We're going to double it from $5,000 to $10,000. Well, if your spending habits are ingrained to be no more than 30% of that $5,000, so you're paying you're incurring no more than $1,500 of debt in any billing cycle on that card, based on the $5,000, they raise it to $10,000. Well, $10,000, 30% of utilization is $3,000, not $1,500. So now all of a sudden, you've got a utilization of 15%, not 30%, which is great. Which means if you have an unexpected purchase that you need to make, which is going to kick up your utilization a little bit, you have some wiggle room. All right, you can make that purchase and still stay within your 30% utilization. So an increase in a credit score, an increase in a credit limit is a good thing. Okay, welcome it. It's good news. Just don't think, hey, I can spend more money. You can, but you're better off staying within your current spending habits. Now, I talked about the 35% of your payment history. Again, nothing dings your credit more than missing a payment. Carrying a balance can force you above your 30% utilization. So pay it off every month on time, and you'll be great. You want a good 2-year history on each report of making the payments on time every month. Then there's length of credit history. And again, we're starting to get into the more minor stuff, and don't sweat the small stuff, but it's good to understand them. Length of credit history is important. And this is why you don't necessarily want to cancel a credit card. Okay. Once you cancel that credit card, then you start losing all that credit history. Remember, length of credit plays into your score. Not in a huge way, but it does play into it. If you cancel that card, you start losing the payment history that it's tracking stops, and the older it gets, the less good FICO juice you have in your credit history or your payment history, because that account was closed out. So you might have a card and you say, hey, I'd like to get this card. I've got a good credit score. This has more perks. It has a lower interest rate. It's really great. I want this card. Well, get that card and use it a little bit before you cancel the old one. All right. So you want to get that, get good for this, because credit cards, unlike a car loan or a mortgage, once you pay off that car loan, then you lose that FICO juice, that payment history and everything else on the car loan, because you paid it off. It becomes older and older. Same thing with a mortgage or any kind of closed-end loan that you may have. You borrow money for 12 months, whatever it is. You lose that. But with credit cards, it's revolving credit. It's always there. As long as the account is open, as long as you're using it and paying it back, it continues to give you a longer and longer credit history, which is good. Creates continuity in your credit history. Credit mix, I talked about this before. You want credit cards, car loans, mortgages, student loans. Now, don't go out and buy a car, okay, or get a student loan just because you want diversity in credit. Don't do that, okay? What I'm saying to you is, if you need a car, if you need to make take out a student loan, or if you're ready to buy a home, okay, you're going to do it anyway. But that's where the credit diversity comes in. And again, we're just talking about 10% of the score. Okay, so again, don't sweat the small stuff. And then finally, new credit is the other 10%. It tracks your applications for new credit. And so be aware that when you apply for credit, it dings your credit just a little bit, as much as 10 points, okay? Because you're applying for more credit. That's more risk, okay? So it's going to ding your credit a little bit. You're incurring some risky behavior. But if you get that credit card, if you get that loan, and after 2 or 3 months, you are making the payment on time, if it's a credit card, paying it in full every month on time, and after a few months, they start, well, there was some risk because you applied for more credit, but guess what? You were able to handle that additional credit responsibly. So your score goes up even more, okay? So it comes down a little bit, but it'll rebound up. What you don't want to have happen is you apply for the score, the credit, it dings your credit 10 points or so, and then you get denied for credit, okay? Also, don't apply for a whole bunch of credit cards all at once. Okay, again, risky behavior. They're going to get a whole bunch of credit cards and run them up. Whoa, what's going on? All right, so you got to be careful of that, because those what are called hard pulls or hard inquiries show up on your credit report. So that can cause a problem. If you're shopping around for the best rates on something, the recommendation of a guy named, I have his name, Rod Griffin, he's the Director of Public Education for Experian, says if you're shopping around for the best deal and you're applying and you have these hard pulls or hard credit checks, and they all take place within 14 days, well, it'll show up on your credit report and you'll see it, but the scoring system will only see one because it's within that 14-day window. So you just be careful about applying. You may see, you've been pre-approved with our credit card. Well, that's pre-approval is not approval, bear in mind. You don't have the card yet, but it is a good sign. They've done a soft pull on your credit. If you're not sure whether you're going to qualify for something, have them do a soft pull to pre-qualify it, all right? Because that's not going to ding your credit up to 10 points. So they do a soft pull and they say, sorry, you don't pre-qualify. Well, all right, you didn't get dinged because it's a soft pull, so there's no harm, no foul on the turn down. But if you do the soft pull, they say, hey, guess what? You pre-qualify. Well, then it's a lot less risky to do the hard pull, the full qualification, because most likely you'll qualify for that card, get the credit, you then use it responsibly, and it helps build up your score. So that's a point. Now, credit reports are key. I said earlier, it all comes down to the credit reports because, as I also said earlier, there are different credit scoring systems. I mentioned Vantage Point, I believe it's called, as well as FICO. And there's some Vantage Score, excuse me. And there are different scoring systems that can be industry specific. But they all come down, and they're all based on your credit report. So if your credit reports are accurate, if you make sure that you do things that are responsible, like I said, not a lot of hard pulls for credit, that you pay off, you have a good payment history, you pay off every month, and you pay on time every month. If you have a car loan or a student loan, you comply with all the requirements of it so that you're being a good boy or girl, that's good. And that whatever the score is, whether it's 300 to 850, whether it's some other scoring scale or whatever this number means, it's all based on the same information, the information in your credit reports. So don't worry about all the different scoring systems. FICO is the most popular and often the most used and a good indicator, but it all comes back to what's in your credit report. So and I said check them regularly. Now, a quick and dirty way to build credit is use each credit card every month. So you're using the credit, pay it off in full every month on time, and stay within your utilization low, 30% or lower. Okay, you can go lower. And just have some diversity of credit as well. Now, finally, your credit reports are free once a year, once every 12 months, but your credit scores are not. You often have to pay for them, but there are ways to get them for free. You may see Discover Card advertises that they put your credit score on your monthly statement. Now, they're not all three of them, but it's at least one of them. You can use Credit Karma. All right, that's a great way. It's a free they pull TransUnion and Equifax Vantage 3.0 scores, and you can get credit reports from both bureaus. So that's an advantage. Credit Sesame is a TransUnion credit score. Credit.com it's the Experian credit score and your Vantage score 3.0. And then there's Bankrate, bankrate.com. That'll give you Vantage score 3.0 and your TransUnion credit report every 3 months. So that's a way of keeping up to date with your scores and with your credit reports. So that's it for this episode of Lunch with a Lawyer. I hope you enjoyed the information. And if you did, I would appreciate it if you click that like button, that thumbs up button under the video. That will help spread this video in the Facebook algorithm to people. Hey, post a comment. All right, as I said earlier, post a comment or a question. I may be able to answer it later. If you have an idea for a topic for a future Lunch with a Lawyer, feel free to post it in the comments. If you saw this through some other way other than liking my Facebook page, you can like my Facebook page and get notifications of the events I set up for these episodes of Lunch with a Lawyer. This episode will also be available on my YouTube channel, richardsonlawoffices.tv. If you found this information useful, then click that thumbs up button. It helps with the Google algorithm and making that video on my channel easier for people to find if they're searching for this type of information. If you not only like the content this video, but maybe other episodes of Lunch with a Lawyer, other videos that I post on my YouTube channel, then feel free to subscribe by clicking that subscribe button. Other than that, thanks for joining, and I'll see you next month.